Hi there, welcome back to this week's episode of Investor Intelligence, brought to you by the team at the Property Mentors. It's your weekly podcast for all things, funnily enough, investment. Once again, I'm your host, Phoebe Sikowski-Wallace, and joining me is our wonderful founder and CEO, and of course, our investment expert, Luke Harris. How are we today, Luke?
Hey Phoebe, how are you?
Very well, thank you. So coming up on today's show, we're going to be talking about some alternative investment strategies that can help you along your investment journey that don't involve getting a loan. Then later on, we'll touch on some examples of some longer-term investment strategies, and by the end, you'll hopefully have a better understanding of how these different approaches will help some depending on what kind of investor they are and what they're striving for in terms of goals. But before we can get into any of that, Luke, let's have a chat about something that is quite topical at the moment. It's pretty topical at any given moment, but something that people are always wanting to know more about, which is interest rates. So Luke, interest rates are at an all-time low at this point in time, sitting at 0.1%. So just to start with some back to basics for our beginner level listeners, but also because I know so many of us were not taught any of this in school, what do low interest rates mean? What are they good for and what are they not so good for?
Yeah, look, interest rates is always an interesting topic.
Nice.
And I think we weren't taught this in school. I was saving that one. And we weren't taught this in school. I certainly wasn't taught anything about interest rates. I didn't know how they work or what they do. The government sets it or the bank sets it. Nobody really teaches you what interest rates are there for and how they go up and down and sideways and how it can affect you as an investor. So really, at the moment, we've got the all-time lowest interest rates. And a lot of the media that we're seeing and hearing right now is talking about interest rates going up or down, fixed rates that are going up at the moment, and really how to interpret what all of that means and how to assess it and put it into your own situation is quite challenging. And especially when you're trying to get started in property investing, a lot of people look at the noise that's out there and look at all of the media and think, well, people are talking about interest rates and that a lot of these big changes could be coming and, they could be going up again. And that means that it's something that I don't fully understand. Therefore, I'm going to sit on the sidelines and wait until all of that noise goes away. And, that makes sense to a lot of people in theory because they don't understand it. So therefore, they're better off and feel safer not doing anything at all. That doesn't actually help you to make any money though. It doesn't help you to build wealth. So getting a bit of clarity on interest rates, what they're there for and how they work and how they can affect you is a really important thing as a property investor. Now, one of the first things that we've got to do is look at historically what do interest rates look like as far as what is a long-term average of interest rates. And that gives us some sort of measure on where they could be going to in the future, where they might rebound back to. And I guess looking at the long-term interest rates of about 7% is not the bank rate, but what you pay is about 7%. That's typically what people will assess their financials on. Now, a lot of people lately, as we've seen in the media, have been going out there and buying a lot of property and going to auctions and paying $100,000, $300,000 more than the original expectation of price. And they're doing that because of the low interest rates at the moment. Now, if we've got rates at 0.1%, that means the banks can offer extremely low rates, very competitive rates. And what that means is that they can access international funds a lot cheaper than they ever have been. Now, we've still got a relatively high interest rate compared to a lot of countries around the world that are sitting at zero or even below zero. So the government's, I should say the government, but the Reserve Bank is essentially keeping that low without dropping it to zero. But the talk of interest rates going up has to be put into perspective because whilst they have been sitting low for quite some time, it was never going to be expected that they would stay this low forever. Now, in saying that, they're certainly not going to jump straight back up to 7% overnight. Interest rates change incrementally and they change relatively slowly. There has been periods in the past, in the last 7 to 10 years, where every month there would be a rate adjustment of some sort when the economy was in a different position. But I think over the next few years, we're still going to see relatively low interest rates compared to the long-term average. And that really is a thing to consider for investors looking to get into the market right now.
Yeah, okay. So as far as home loans go, low interest rates are quite good news, but what does it mean for people and their savings?
Doesn't mean anything good. If you've got your money in the bank, you're very much going to be getting less than the inflation rate on your savings, which means if you've got money in the bank, you're probably going backwards. That means that, if you think that the old-fashioned view of saving money for retirement, nobody really saves themselves to wealth, because the returns that you can get by putting your money into a savings account, even into a term deposit where you lock it away for a year or two, the rates are so low that you're not really even keeping up with inflation. So it is a really tough thing for people that want to get ahead financially, where they want to do something that's safe and secure, which is essentially leaving money in the bank, but they also want to get a good return on their investment. Now, putting money in the bank really isn't much of an investment. It's just a parking spot for your money. So because of that, there's very little risk involved. The government's guarantee up to $250,000 in any of the Australian banks. So it's quite a secure investment putting money in the bank. Therefore, the returns are very, very low. As I said, you're probably not going to keep up with inflation, which means money in the bank is going backwards. So if you're looking to invest, you're going to have to do some things that are a little bit different. You're going to have to do something other than leave the money in the bank. You can certainly park it under the bed, put it in a safe at home, or bury it in the backyard. A lot of people want to do those types of things. But at the end of the day, that's certainly not going to be earning anything. That's just going to be parking your money without putting it in the bank. Some people don't trust the banks, don't like the banks, and they just prefer to put it in the cupboard at home. And that's fine if that's their plan, but that's not really an investment strategy, is it?
No. And why are there some people who can't get home loans but do want to invest in property and very much have the capability to invest but aren't able to get that loan?
We found many years ago that a lot of our members were out there in the marketplace wanting to invest, and for whatever reason, might be because of their age or their employment status, some people self-employed, for example, or maybe in between jobs, and they're not able to apply for a loan. There's a number of reasons why people can't or don't want to get a loan for a property, and they still want to go out there and invest, but they don't want to take on debt for some reason. So either they can't take on debt, they won't be able to qualify for finance, or they simply don't want to get a 20 or 30 year mortgage for whatever reason. They might be planning on moving overseas in a few years' time, or any other number of reasons. So there are other ways of making money without actually buying a property, but most individual investors don't know about them because they're actually not out there on a day-to-day basis finding those opportunities.
Right, so it's not typically made available to the general public. But one of the things that helps build a substantial portfolio, which can significantly change your circumstances, is how quickly we can get onto that first or that next opportunity. And here at the Property Mentors, we're very mindful that we help our members get into great property opportunities, but we also want to offer ways that can help people shorten that time frame in between now and that next opportunity. Because a lot of people, as you said, have some savings just sitting in a bank account, for example, but as we just said as well, the interest rates are at an all-time low, so your savings aren't really doing a lot in terms of gaining interest over time to contribute to, say, saving for a deposit.
That's right. So money in the bank, very much a low interest rate, but also it's safe in that you can't lose your money. So a lot of people like the fact that, okay, well, I'm not going to invest right now. I'm just going to leave it in the bank. I might get low interest, but my money's safe. I'm not going to lose it. And obviously, if you've saved that money up over a long period of time, of course you don't want to lose it. But at the end of the day, if we don't step out of our comfort zone and invest, then we are just going to sit idle and really tread water with our financial situation. So to get ahead, we're going to have to invest at some level. We're going to have to do something with our money. And if we're going to get ahead quickly, we're going to have to really educate ourselves on what opportunities are out there, understand how they work. And I always teach people this: before you invest in anything, make sure you understand it before you say yes or no. See, because if you say yes to something that you don't understand, then what could happen? You could lose your money, right? Things could go wrong, right? If you say no to something you don't understand, what could happen? you might miss out on one of the most amazing opportunities that can help you move forward if you've said no to something before you understand. So we're not suggesting that anybody just goes out there and tries a whole bunch of stuff and hope it works. We're suggesting that people understand other investment opportunities that are out there, know about them, learn about them, ask questions about them. If they're suitable for you, fantastic. That can form part of your strategy. If they're not suitable for you, at least you've said no to something that you've gone through the process and understood it. And I think too many people rush into things and they get involved in investments that they don't understand purely because they're looking at the return on investment only, and they're not looking at the fundamentals of the investment or how it's structured or who's involved. There's a number of factors that you need to consider when you're looking at any investment.
Yeah, this is where that educational and emotional readiness that we're always talking about comes into play. But the good news is that getting a loan is not the only way to buy property or to get into the market. And I want to talk about one of the short-term strategies that we offer our members here, which is called Become the Lender. So Luke, talk me through this. What does Become the Lender mean?
Become the Lender is really a peer-to-peer investment opportunity, and it's available only for the Property Mentors members. So once you are a member, you get access to this particular strategy. A lot of our members have done this quite successfully in that they've been in a position where they're maybe in between property purchases. They might have just secured investment property. They might have a little bit of funds left over that they want to do something with. Now, obviously, a savings account, as we've just discussed, is one option. Putting it in an offset account to offset your mortgage might save you 2 or 3%, depending on your interest rate. But a lot of people know that that's not really working for them. It might save them a little bit, but it certainly doesn't get them ahead. So we realized many, many years ago that a lot of our members were in that position where they wanted to advance their portfolio, but they really couldn't do anything other than wait for equity growth in their portfolio and save. Obviously, you get some tax benefits with your investment property if you've secured one that's giving you good depreciation benefits. But really, a lot of our members wanted to fast track. They wanted to say, how do I use the leftover funds that I've got? I keep saving every month. I keep saving money. How do I make money other than just putting it into the bank or into my offset account? So what we did was really sat down with our team and we looked at all of the options available, and we realized that obviously ourselves at the Property Mentors, we have our own property development projects. I obviously do projects of my own, but at the same time, there's other avenues out there where people want to invest in property and get a return on that investment. Peer-to-peer lending is becoming a huge thing, and it has sort of arisen with technology over the last 5 to 10 years. People lend money to other people all day, every day. It's just that you don't have a platform to sort of go to where you can say, hey, Phoebe, I want to lend you $50,000 because I know you're doing a development project. It happens all day, every day. I've got developers that I know personally, and one of them borrows $1 million off another one, and another one borrows $500,000 when they need it. It's usually just a timing factor. Now, for a developer, when they're doing a particular project, they're often doing, and we're talking about professional developers here. We're not talking about mum and dad developers that are trying their first development. We're talking about serious developers that run development companies. Okay. Now, development companies have to go and get money from somewhere, whether they go into the money markets and secure funding for a $10 or $20 million project. They might go to private lending. They've got their own lenders that they go to that specialize in development funding. And of course, there's peer-to-peer lending. Now, peer-to-peer lending is very much the same as one developer saying to the next, we're going to borrow $1 million off each other and we're going to pay whatever the interest rate is on that. Now, whenever a developer's doing a development project, the speed of getting access to funds is probably more important than the interest rate that they're paying. And I want to say that again, the speed of the pace that they can get the money is more important. And the reason why I say that is because if there's an opportunity to essentially bid on a development site, developers might want to access money quickly so that they can do a good deal on a property. Right? If they can secure a development site, that might be very time sensitive. Something might come on the market. If they can pay this price in this time frame, they can save themselves a huge amount of money. So a developer might save themselves $100,000 or $200,000 or $300,000 by buying a development site sooner. Right? If you put an offer subject to finance and it's 90 days for finance and there's extensions, there's a lot of uncertainty in that for the vendor. Now, if a developer can go and say, hey, we can settle on this property in 30 days, but here are our terms, right? Here's our terms, here's our price. and the developer gets a really good deal because they can do it quickly, that means they might pay a little bit more for access to that capital. And this is, as I said, this happens all day, every day. This is the next level of property negotiation when you're in the development space. A lot of developers are doing big deals all day, every day. Now, the access to that capital means that they might pay a higher interest rate for that. They might pay 7, 8, 9, 10% interest for that money because of the fact that it can be done quickly. Now, if that means that they can save $100,000 or $200,000 on their purchase, do you think they'd be happy to pay a little bit more interest to have access to those funds?
Absolutely.
They might need to put down a $500,000 deposit, right? And if they've got that $500,000 tied up in a different development that they're finishing off, if it means that they can put this deposit down by borrowing it privately, they can do that, finish off their other project, and then roll straight into this one. Now, for a lot of people listening to this, that might sound extremely risky, and you're thinking, look, I would never do that. I don't know this developer. I don't know who's involved, and I would never do that. I don't care if it's 10%. And that's fine. We're not suggesting that anybody rushes out there and knocks on the door of a developer. But at the end of the day, these things do happen all day, every day, and there are protections in there for the lenders. But what we've discovered is that a lot of our members were interested in this type of investment. Now, this doesn't mean that all of the opportunities are going to end up that way. It might not be for a property development. It might be for a block of units, or it could be for another type of property-based investment. And it might be for a shorter period of time. It could be 12, 18, or 24 months. And typically that's the time frame that we target. The thing is, for most individual investors, if you wanted to access this type of investment, where do you start? Where do you go out there and do you start ringing all of the developers do you do a Google search on developers that want to borrow money? If you rang up a lot of developers off the internet and said, hey, I've got $100,000 sitting in my offset account, would you like to borrow it? Most developers are not going to entertain you. They're not going to have that conversation with you. And the reason is they don't know you. And they don't know why you want to lend the money, and they don't know what terms or how that's going to work. So essentially, the property mentors, we're here as like an aggregator, essentially. Mm-hmm. We've got a lot of networks that we can tap into and we can access at any point in time. We're always looking out for ways to protect our members as far as how their funds are secured. But obviously, when you're lending money to somebody, you need to have a formal agreement in place. You need to have a loan agreement. So there's a loan agreement that goes in place, and that essentially gives both the borrower and the lender their relevant protections. And of course, you get legal advice on that. Make sure you understand it and so forth. But the returns that are available can be anywhere from 6, 7, 8, 9, or 10%, depending on where it is, what time frame it is, and who's involved, and what sort of security level you've got. But we've had some great success over the years with this for a lot of our members, and we've got access to a couple of different development projects that people have done. But Become the Lender really is the way of flipping it around, and rather than the banks getting the profits, our members get the profits instead.
So who does Become the Lender suit? Like, what do their circumstances look like?
Become the Lender, look, our members that have invested in this particular strategy have come from all different backgrounds. We've got people that have been out of work for a period of time. There was one gentleman that finished up with his work due to medical reasons, but received a payout of a sum of money. And so he realised that he couldn't get a loan for a while. He wasn't working. So he's invested into our Become the Lender strategy so that he can get a monthly return on that. We've got people that are in their 60s. They don't want to take any more debt on, but they do have access to capital that have sold down other assets. They've got a bunch of cash. They prefer to get a monthly return on that rather than leave it in the bank, and they're getting a 7% return on those funds. There's other people that are self-employed that might have a property portfolio. They're running their business, but they might have a little bit of extra money in their business that is just sitting there. It's not doing anything for them, and they don't need it as working capital for their business. So they've put it in as a short-term, 12 to 18 months into a Become the Lender investment and getting 7 or 8% return on that.
Yeah, fabulous. So you can see how something like that is a much better result than just having your money sitting in a bank account and earning basically next to no interest. 8 to 10% is quite a jump up from 0.1%.
That's right. It's a healthy return. But look, at the end of the day, I've seen things on Facebook and on internet searches, things pop up on the side where people are offering 20 or 30 or 40% returns by getting involved in various things in property. the reality is that a return that's promised doesn't necessarily mean that it's going to be paid. So you need to look at the investment in its entirety and not just look at the returns. The same way you would look at a property investment, the same way you'd look at any other investment, you need to look at the fundamentals. As we said earlier, who's behind it, how it's structured, what security you've got, and make sure that you understand the entire investment and not just the returns involved. Because being offered a 30% return is all well and good, and it sounds enticing. But if you realize through the actual legal documents, there's zero protections for you. There's no way of pursuing anybody if the thing goes wrong. And more often than not, you'll find that there's more horror stories from people that have been offered these amazingly high returns than there are positive experiences. Now, there was a company, I won't name names, but there was a company recently that was all over Facebook advertising 30 and 40% returns to invest in development projects, and that company's no longer around. And there is over $10 million of people's funds that have been lost. So we're much more of a conservative approach to our investing, the same way I invest myself. And the reason I've been able to successfully invest for the last 20 years or more is because I do take a conservative approach. Now, we're not going to do anything that is risky. There's going to be risks involved in investing, but we do need to mitigate those risks. Now, as the investor, we need to make sure that we are across who's involved, how it's structured, what the risks are, what the returns are, and we need to be accountable for our own decisions. Now, no investing is risk-free, but if we're looking at a more reasonable return, 8 to 10% is a reasonable return for the investor, but it's also a reasonable fee to pay for a developer or for another investor that might need those funds. And it is actually a win-win. So the whole purpose of this is that it's a win-win. For the developer, it's a win because they can access funds a lot faster than what they would if they went through a normal bank application process. And it's a win for the investor because typically they can't access these investments anywhere else. And they're certainly not getting those types of returns in the bank. So everything we do here at the Property Mentors is a win-win. And we always teach people, if you can't see the win-win, don't do it. It's very simple.
If you wanted to get fit or start a fitness program, you wouldn't run a marathon if you hadn't yet mastered jogging. You also wouldn't begin weight training by lifting 30-kilo dumbbells. There are, of course, multiple ways to keep fit through a variety of sports and exercise programs. However, there is a process to getting into shape and achieving peak performance. It's the same when it comes to investing in property. You need to start by doing some self-assessment of where you are now to where you'd like to be. This would be your fitness test. You have to find your team of experts who will help you along the way. These would be your trainers. And learn how other people invest, including the mistakes they've made. Only then can you start to look at how you will achieve your property investing goals. Property Fit assists you with all of this. It's the latest book from experienced property investor, entrepreneur, and founder and CEO of the Property Mentors, Luke Harris. It's the book that will guide you through the groundwork you need to cover before you start investing, exploring all the ways to invest in property by helping you find a strategy that will lead to the ultimate goal of financial freedom. Property Fit is your easy-to-read, practical book including mentor tips and mindset insights, as well as proven strategies that seasoned investors or those just starting out in property will find invaluable. Visit propertyfitbook.com.au to purchase your copy and get your property portfolio in shape for financial freedom. So Become the Lender would be considered a short-term alternative investment strategy. Luke, talk to me about some of the longer-term investment strategies that also don't involve getting a home loan.
So one of the other things that I've done over the last few years is set up what we call wholesale property trusts. Now, these are private trusts that aren't advertised anywhere, and they're essentially for our members here at the Property Mentors. Now, a property trust essentially is a group of people that have got together, put their money together, and they go out and buy some properties. Now, that's essentially if you and your friends got together, Phoebe, on the weekend, and you got up to 19 of your friends, so up 20 people in the group, got together and you put all of your funds together, you bought units in a unit trust, and then the unit trust goes out there and buys a bunch of properties. Now, it's very difficult to coordinate that if you don't have the friends that have the money available that also understand the long-term fundamentals, but also understanding why you're putting this thing together in the first place. So we realized once again that our members were out there. A lot of them wanted to buy property, but they couldn't go and get a loan, or they didn't want to do a short-term strategy. They wanted to invest for the long term. And so we put together unit trusts, which give people the ability to buy into a property portfolio. And so the wholesale property trusts are something where people can get involved from as little as $75,000. It's an invitation-only opportunity. So you can't just, if you come to us and say, we've got the money, we want to do it, you can't just do it. You have to be invited by one of our mentors. And that's a long-term strategy. Now, the trust is 80 years. So it's probably going to be around long after I am, depending on how good medical technology gets over the years ahead. But essentially, these trusts are run by the property mentors, and we launch them every year or two. And essentially, there is, I guess, a long-term history there of actually adding properties to the portfolio. We keep them very conservative in that we don't have lending over 50%. So they're capped at 50% loan to value ratio. And the reason we do that is because it's a long-term and a conservative investment. We don't gear the portfolio up to 90 or 95%. So it's very much a conservative approach to building a portfolio. And a lot of investors that want to be involved in property but can't get loans love this, because the actual unit trust itself takes on the debt and takes on the loans rather than the individual investor. So from an investor's perspective, it's very much a passive investment. And it is something that, as I said, it's a long-term investment, and it can produce some amazing results, because over time, as the portfolio grows, the trust can go back and get more finance and secure more properties. So over the medium to long term, the trust will continue to grow as it continues to invest in more properties. But as we covered before, imagine if the trust has $30,000 or $40,000 left over that it can't use for a little while, and it's just sitting there in the bank account. What could the trust do with that money?
Put it into another development or another project.
We could put it into another project, such as Become the Lender, and Become the Lender could get that higher return for a next little while until it's ready to go and purchase its next property. So we're always looking at maximizing the portfolio. So there's a lot of different options out there. Again, you won't see this stuff advertised anywhere. It is a small scale private offering. It is regulated by ASIC that way. And based on that, obviously, it's an invitation-only opportunity. So it does need to be offered by one of our mentors, and it's something we're certainly just talking at a high level today as to how it works. There's no actual offer available today, I'm sorry. But if you need to know more about that, obviously, have a chat to one of our mentors and they can explain in more detail.
Yeah, it's still good to know that these kind of things are out there, because again, we're not taught this in school, and we're taught that we need to go to university to get a good job so that we can save and get a loan and pay that off for the rest of our lives. But there's alternatives.
Get a good job and work hard.
That's right. Yes. But I can see how this is tying back into what kind of investor you are, and how different types of investors will need those different strategies, and not all strategies involve getting a home loan and buying property. You know, that getting a loan and buying property are not the only ways into the Australian property market. But just to recap, you're saying that a strategy can look like buying property, but it may also look like putting money into a development project and letting that earn you interest by becoming the lender, which can shorten that time between purchasing either your first or next investment, or a longer term strategy that relies more so on capital growth, which allows the kind of investors who almost just want to sit back and let their mentor and their team of experts do everything to build that portfolio and, of course, their wealth. Is that right?
Yeah, absolutely. That's correct. And I think the thing is that whilst, like we said before, whilst these things are available, they're generally not available to the public. Most people will never find them. You won't find them on Google. You certainly won't, find them at the Sunday barbecue with your mates. But at the end of the day, all we suggest is that people consider alternative investment opportunities that are out there. Doesn't mean that they're going to be suitable for everybody. There's going to be a lot of people that are going to be extremely risk averse. They don't want to invest in anything that they haven't heard of or seen before, and they're going to run the other direction no matter how good it is. All we've suggested on the call today is to really get an understanding of the different opportunities that are out there, explore them, learn about them, ask questions about them, and if they're for you, then explore them more. If they're not for you, that's fine. there's no one here holding a gun to your head. But I think the main thing here with our focus at the Property Mentors is to educate yourself. We want you to educate yourself, learn about what you're doing, learn about the options that are out there for you. And you might just find that you've accessed a strategy that you've not seen before that might actually turn out to be amazing for you and fit in with that long-term plan that we always talk about.
So Luke, if this has sparked an interest in anyone who feels that any of the strategies we've spoken about today could really help them, where can they go to find out more?
So the best option would be to go to thepropertymentors.com.au, have a look at our website and schedule an appointment in with one of our team. Have a chat to them, discuss your goals and what you're looking to achieve, find out if any of these opportunities are suitable for you. But of course, make sure that you focus your attention on educating yourself. Learn about them and ask the mentors to send you some information that you can learn about, and not specific on any opportunity, but just the actual strategy itself, how it can work, how it's structured and what's involved. And as I said earlier, is once you go through that process, that education piece will get you to the next level with your knowledge base, because you'll learn about something that you may not have seen before. And especially as a property investor, it's nice to know that there are other options other than just securing a property and putting a tenant in it.
That's right. And if you want to find out any more about the Property Mentors, you can go to the same website, propertymentors.com.au. Property Fit, which is Luke's fantastic new book, is now available for purchase, which you can find at the website propertyfitbook.com.au. Thank you so much again for listening to today's episode. We'll see you again next week. And Luke, once again, thank you.
Thanks, Phoebe. Have a great week, everybody.